welcome to Pro Traders Price Action Course, episode 3 with me, Simon Davis, also known as the Zone Trader. And since we're in a range-bound market these days, it'd be good to talk about how to trade a range. So as you can see here, it's trending, and then now we are range-bound, stuck in a range. It's a 200 odd pip range, but still we're stuck in a range, and we need to know how to trade these. So best thing to do is mark off the tops and bottoms of the range to the highs, not the wicks, but the highs, and then mark off the middle, which is your equilibrium of the range. And you can also mark off the quarterly 2 lines as well. So you've got 4 quarters. Your range is now in 4 quarters. And then if price is in this quarter, you can look for sells, and if price is in this quarter, you can look for buys. Price can go anywhere from now on. It can go up or down in the range. You've got to watch out for which way it's going to break out, because it could break out and fill the void in, or it could break out a bullish flag, this being a bullish flag, and run stops for distant highs. We don't know until it gives us a signal of where it's going to actually go. So in range-bound markets, we look for turtle soups either side of the market. So on a 4 hour here, we've just broken down the daily into a 4 hour. Just have to clean this up a little. We look for turtle soups on the outer edge of the range. Also, price will go from the middle of the range to the outer of the range, back to the middle. A bit like if an elastic band was around this middle equilibrium line. Price comes down, touches the outer edge roundabout, and then contracts back, goes up, contracts back. And that's what creates the range. Is the pull in and push, the pull in of the force of the middle of the range. So you see prices heading towards the middle of the range now. Potentially to take stops above this 4 hour here. Okay, so we look for turtle soups on the outer edges of the range. So although we probably wouldn't think we were in a range here, there's a turtle soup on the outer edge here. So we enter a trade, or look to enter a trade after it's broken above. So it's cleared stops below the low, which is creating a turtle soup, and then comes back into the range. Once it comes back into the range, you can then look and scout out, looking for scope out, looking for setups. Because this is on the 4 hour. If it's on the hour, you could actually just enter a trade off an hourly turtle soup. So you see a clear order block here as well, and an order block here. So on the outer edge of the outer edges of the range, you can trade order blocks or turtle soups. Join this one up. This would be an order block. Also, turtle soup on the outer edge. We've got breakers in here and everything else, but mainly it's order blocks and turtle soups. Price comes back up to the top of the range, then you look for turtle soup, and order blocks. Let's come back down to the middle. In the middle you find nice order blocks to trade continue down. Then it comes right back down below the range, but I wouldn't call this a breakout. Then you've got the breaker, which we talked about, sending them back up to the middle, consolidate into the mid. Might consolidate in the middle, then continue up to the top again, comes back down to the middle, because this is the middle line. Double it up. Middle line, then back, so it bounces off the middle this time, comes back into an order block, turtle soup, down we go, back to the middle, bounces off the middle again, and then breaks through the middle fast to the bottom, to the middle, to the bottom, to the middle. You see the pattern that the range bar market creates. So we can see that we're in the lower quarter of the range bound market at the minute, and this is why we're looking for sells down here, either off this order block or like this order block, or even this order block here. If you entered this order block, you would still be safe because you have a 30 pip stop loss and 60 to 90 pip take profit, which is a 3-to-1 risk reward. And with a 3-to-1 risk reward, obviously it's not going to be perfectly 3-to-1 all the time, but on a, like, if it's just to do the maths to get a rough understanding on where you are, if you do a 3-to-1 risk reward and you rate trade in sets of 10 in probabilities of 10, so you don't look at individual trades on their own, you look at a group of 10 trades all in a row and how you did. If you win 5, lose 5 with a 3-to-1 risk reward at 30 to 90, you're 300 pips up, even if you're a 50-50 trader, and you lose 5 and win 5 within 10 trades. So keep that in mind. It's really good to know that. Trade in probabilities of 10 or more if you want, but no less than 10. Trade in probabilities of 10. Obviously that doesn't mean you trade 10 times at the same time, but just group the trades up and then analyze them together as a whole, as a one unit. So in 10 trades, I lost 5, won 5. If you stick to your rules of 3-to-1 risk reward at 30-90, you will be 300 pips up and become a profitable, consistent trader. And this is exactly what I'm here creating this training for you today, is this series, Pro Traders Price Action course, so you can become a profitable, consistent trader. And until next time, stay patient, stay focused, and have fun. And if you like this video, please like, comment, and subscribe. Comment below any questions, I'll answer your questions. I see some of you asked questions last time, I've answered those. Feel free to ask questions on this, I'll answer those. And if I don't know it, I'll try and find out for you. Also, I have an Instagram page at Zone Trader. Please follow me, I'll follow you back, and we'll be in each other's journey to help each other become more consistent, more profitable trader. Thanks again for listening. I've been Simon Davis, also known as Zone Trader.